Many economists have agreed to the fact that the long-term effects of inflation depend a great deal on the money supply, and that hyperinflation is the extreme scenario of effects of changing economic conditions. Bearing this in mind, this video will be looking at how to protect and benefit from hyperinflation. Do not forget to like the video and click on the red bell icon to subscribe to this channel if you have not done that. Without wasting more time, let's delve into the business of the day, how to protect and benefit from hyperinflation. A sustained rise in the prices of goods over a prolonged time is a feature of inflation, and also if there is an increase in the demands for certain products and services, it can lead to a general upward trend in pricing. When hyperinflation happens, there's a major decline in the purchasing power of money, currency values don't stretch as far, and this happens over a short period. Inflation is not rare, but hyperinflation is rare. But it can and does happen. It is more often in developing countries or countries with emerging and developing economies. Hyperinflation happens more quickly and is characterized by a price increase of half the original price over 30 days. The only way to deal with it is successfully investing your money in businesses that are likely to protect and benefit from hyperinflation. Continue watching this video to find out how to protect or benefit from hyperinflation. Number 7. TIPS. TIPS, the acronym for Treasury Inflation Protected Securities. TIPS and market funds are the cash investment of choice to protect from hyperinflation. Why is that true? The rates market funds and TIPS pay to fluctuate simultaneously with investment interests, and they automatically adjust upwards as their rates increase. The money market interest rates increase with the general market, so there's no fear of loss of market value that plagues the fixed-rate investment during the time of hyperinflation. TIPS can be bought in denominations as small as $100 through Treasury Direct. They are very easy to buy. To know when they are sold, you should check the Treasury Direct website, or, better still, you could buy from a broker. If you don't have the intention of buying TIPS directly, you could invest in TIPS through an exchange-traded fund, ETF, or index funds. TIPS pay regular interest to make the annual adjustment, down to the principal and based on the Consumer Price Index, CPI. If the CPI drops, your principal will reduce, but TIPS, if it holds to maturity, will pay at least their true value. The interest in TIPS is paid twice annually, and the value is adjusted based on the CPI. This gives you your regular interest income, plus an additional annual adjustment for inflation to your principal value. Number 6. Gold investment. Investment in gold is a good stance against hyperinflation, and many people have looked to gold as an alternate currency, especially in currencies where the normal currency is losing value. Gold is a real, physical asset that holds value and can stand against hyperinflation, but only up to an extent. When inflation happens, the central banks tend to increase interest rates as part of the monetary policy. If that happens, holding onto an asset like gold that pays no yields is not as valuable as holding onto an asset that does. But gold is good because with hyperinflation comes the general increase in the price of goods and commodities, gold inclusive. Number 5. Real estate. Hyperinflation is kind to real estate because as it rises, property values increase. It is in actuality the ultimate hard asset that sees a steady price appreciation during periods of hyperinflation. Also, as rent rises with inflation, people are increasingly interested in owning real estate and getting the tax benefits that help offset the general level of inflation. You can invest directly in individual properties, commercial or residential, or you can also invest in REIT, Real Estate Investment Trust. REIT is like the Equity Residual Trust, EQR. If you want crowdfunding that offers REITs, consider Streitwise. But REITs have some drawbacks, including sensitivity to the demands of other high-yield assets. Number 4. S&P 500. Stocks offer the most upside potential in the long term. Businesses that gain from inflation are those that require little capital, but businesses that utilize or engage in natural resources often lose. S&P 500 are currently one of the high concentrations of technology businesses and communication services. They account for a whopping 35% stake of the index. Technology and communication services are businesses that use small capital, which make them good protection for hyperinflation. S&P is an index of the 500 largest U.S. public companies, one of which is that it gives higher weights to companies with more money capital, and another is it does not provide exposure to small capital companies. Number 3. Loan leveraging. A loan that is made to companies that already have a high level of debt or a low credit score is called a leverage loan. This kind of loan has a higher risk of default and is more expensive to the borrowers. They are typically referred to as collateral loan obligations (CLOs), and they are not pooled into one security. This makes them good protection against hyperinflation. Number 2. Commodity. There isn't a direct correlation between the price level and a commodity. Commodities like grains, electricity, beef, oil, orange juice, natural gas, precious metals like gold and silver, as well as foreign currencies and other financial instruments are good against hyperinflation. ETFs are ways for you to broadly invest in commodities, but before that, you should be aware that commodities are highly volatile. And investor caution is necessary and advised in commodity trading because commodities depend a great deal on demand and supply. Number 1. Stock market. Equity investment is effective to protect and benefit from hyperinflation. Although it can't withstand inflation, it can withstand spikes. Rapid inflation is very tough on businesses, and they absorb higher prices too. Because of that, you'll need more money to maintain the same productivity level. To play defense, it is best to invest in companies that can stand through the hyperinflation period without being unscathed. Hyperinflation may be a factor in the coming months. Chances are that it will be happening, and it will be uneventful. To protect and benefit from it, you need to prepare by de-risking your investment portfolio while continuing to invest wisely. Consider talking to financial advisors about how hyperinflation may affect you and what you could do to soften the blow. Protecting yourself from hyperinflation and setting up plans to benefit from it is important if you think hyperinflation is coming. To be on the safe side, shore up your finances, so if the economy goes sideways, you'll be glad you did. If it doesn't, you have nothing to lose. Having stayed to the end of this video, what are your thoughts on the topic? Which one of them do you think you can do? Which one do you think is the best or the easiest? Do not hesitate to drop your suggestions and opinions in the comment sections. Also, remember to like this video and subscribe to our channel for more engaging content. Bye!